Okay, I think we will go ahead and get going. We've got good attendance today, a lot of interest in our topic, which is going to be Insights 2023. And so I've got a few things that I want to share today and have got a few irreverent views of some of the things that have gone on in 2022 and what was kind of a difficult year, to say the least. So let's kick this off here. And so we want to talk about today about getting a grip, and I'll talk about that a little bit more in detail as we get into the presentation here. Here's our very, very important disclosure. But I want to thank you all for joining us today. We've got a number of serious things to talk about, that's for sure, because we are allowing questions today. So we have the Q&A and the chat open. So if you have anything along the way that you'd like to discuss, please drop it in there and I'll answer those along the way. I like to start these off, besides ridiculous videos, with a poll just to see what everybody's thinking out there. And so this first one I'm going to start with is, do you think inflation will be higher or lower by the end of 2023? And this should pop up on your screen. And if you wouldn't mind plugging in your answer, I'd be real interested to see what everybody thinks. All right, the answers are piling in. All right. You guys are doing great. I love the participation. Okay, I'm going to end it because we have a pretty clear trend coming here. All right, so the question was, do you think overall inflation will be higher or lower by the end of 2023? And the results were 77% say lower and 22% say higher. And so it was trending into the 90s on lower, and then we had a few later in the year, or later in the poll, say it's going to be higher. So that is really the question. Inflation and interest rates are the question, and we're going to talk quite a bit about that today because it's imperative as we look out to answer some of the questions that we're hoping to answer on today's presentation. So, all right. You met our friends, so thanks, guys, for your input into this year's outlook. I've titled it this year, Getting a Grip, and I did this for a reason. So for you, those of you in Des Moines, you're probably familiar with this little hill that is on Grand and 63rd. And so it's a weird place for a hill like that because there's not a lot of topography changes in that area. But if you are going what would be east on Grand during an ice storm or a snowstorm in Des Moines, you have seen some poor souls stuck on this hill because they can't get a grip. And I've many times seen some of these rear-wheel drive little cars or older cars just end up in a dither of trouble as they go through this hill because they can't get a grip. It gets real icy real quick, and it's steep and it's kind of long as well. And so what it seemed like last year in 2022 is that nothing was able to get a grip. And I referenced in the Insights piece that we're going to release later tonight that it was one of those years where nothing did well. And so I don't need to repeat that for you. You all felt it. You were all in the mix of getting your statements and seeing your results online and know that whether it was stocks or bonds or whatever, nothing really got a grip. And that's really unusual because we diversify for a reason. And we talk about investing in different places for a reason. So that assuming if something isn't getting a grip, something else will. And so this was one of those years, though, where that was not the case. And so it leads us to ask the three questions I want to help you answer today, which are, one, are we going to be okay? And I mean all of you and your families, you and your investment plans, your financial plans, are you going to be okay? Second, how are we going to know that? How are we going to know that we're okay and maybe there's greener pastures around the corner? And then the third that we always talk about is, what should I be doing? Should I be thinking about something different, behaving differently, adjusting my plans? What exactly should I be looking at now that we're moving into the new year? All right. So just want to begin with the belief that, yes, we are going to be okay. And perhaps that seems a little pie in the sky, a little too optimistic. But if you work with PrairieFire, then you have a plan. And every plan that we builds in some room for uncertainty because that's what we always will have. And so while it can seem difficult when we see the values of our stocks and bonds go down, it is one of those times where the plan can back that up. And the reason that we do them is so that we can stay stable during these times and stay invested and keep doing what we're doing and doing the best for ourselves and our families. And so the consensus that's coming out of Wall Street right now, and I referenced it somewhat comedically in the first part, but is that basically we're just going to have another tough year. And it's strange to me because generally when I've looked at these forecasts, and I've been doing this for 20 plus years, we've had most of the forecasts when they come out of the year are very generic. They say things look decent. We'll probably have a little bit of an up year, and we'll see how it goes from there. And then it's comic to me because then around the second quarter, third quarter, they all go in and change their forecast. Well, man, you can't do that. You can't say this is what's going to happen for a year and then, of course, change that forecast. But that's unfortunately what happens. And so when I look through, I'm guessing over 100 emails with different forecasts from firms from Goldman Sachs to JP Morgan to Morgan Stanley to smaller asset management firms and hedge funds, and they all that seems to be pretty gloomy with their consensus forecasts. And again, I find that odd. I want to share a quote with you from Laszlo Barini. He's a longtime stock manager and knows Wall Street very, very well. Spends a lot of his time dissecting the financial press and a lot of the misrepresentation that's out there in the financial press. But his quote was for this year's forecast was, "Our key takeaways from this year's batch of forecasts are the economy is not currently in a recession, but will be later in 2023, and corporate earnings will fall, which means the stock market will decline in the first half, but will rally back in the second half. These forecasts remind us of a parlay bet at the local horse track, or of the gentleman who made a bet on the outcome of 7 games in different sports over a few years. There is not a 0 probability of getting it right, but the probability is very, very low." And so the chance that things skate according to consensus this year are unlikely, because in 6 months, I'm confident that we'll be talking about something completely different than what we're talking about right now. And so 6 months before the war in Ukraine, we weren't talking about energy prices and the challenge of getting natural gas into Europe, but sure enough, it happened. And so what could it be this year? You know, China and Taiwan, a skirmish with North Korea, some sort of domestic episode that upsets the apple cart. But the thing is, if we have a plan, we can weather these ups and downs, and we build some of that cushion in there and do all that we can to get everybody through times like these, because we have to plan for a range of outcomes because we just don't know what they're going to be. So one of the things that are different that are different right now and that was different in 2022 is the way that bonds have behaved. And so we've always looked at bonds as a safe investment. They produce income. They are debt instruments of companies. And so historically, they have not traded anywhere near the volatility of the stock market. This year, that changed, and we saw bond values go down because interest rates went up. So when interest rates go up, let's say you have a bond that's at 2%, and then all of a sudden that bond is now at 4%. Well, nobody wants your 2% bond anymore because they can get them at 4%. So the value of your 2% bond goes down in price. So that's what we saw happen across the board, from 5 to 6% losses in some parts of the bond market to 30% plus losses in long-term treasuries. And so it created a dynamic where we usually use these bonds to buffet our portfolios from stock market volatility. Usually one is getting a grip when the other isn't. That didn't happen this year. So I point that out because it makes it a unique year and a unique time that generally won't last. And so I don't want you to get over your skis thinking we have to abandon bonds, we have to just go to cash, do those kind of things, because again, we plan for this kind of volatility over time. All right, genius. So how are we going to know? When are we going to know when we're okay? And so my firm belief is that you won't hear it from the media. And so if you watch the financial press from CNBC to Bloomberg to wherever you digest your content, the news is generally pessimistic. And the reason is because pessimism sells. They need clicks, they need ad revenue, they need things that are going to bring in viewers. And generally speaking, pessimism does a better job of doing that than optimism. And so David Kelly is the economist at JP Morgan that I highly respect. And here's a quote from him. "While news outlets and social media feeds will continue to draw on an audience by raising the alarm on a wide range of issues, no one will cover any improvement in the economy, any lessening of global tensions, or any resolutions of the issues that have plagued markets in 2022. So what he's saying is, if things get better, if things begin to, we start to see the economy stabilize, interest rates stabilize, inflation begin to come down, while it might get a comment here and there, it's not going to be a headline, because the headlines, they like them are, Wall Street is crashing and we have a 1,000-point down day, interest rates skyrocket. These are the kind of things that they use and do to promote their product, and it needs to be taken with a grain of salt. And it's incredibly gloomy right now. And so we have a new market strategist via my Sanctuary network named Marianne Bartels. And the Sanctuary team was fortunate to bring her out of retirement after decades on Wall Street, including Merrill Lynch and some of these places. And she's been teaching us all on our Monday calls about what's called episodic volatility. And so what that means is that when there is a news piece or a data item that comes out, it creates volatility based on that episode. So today's market's a good example, where we had a good labor report this morning, 200,000 plus jobs added, which we think, wow, that's great. The economy's doing well. Well, the market's sold off because the concern is if the economy's good, the Fed will keep raising interest rates. And this fickle Fed is what is really driving a lot of what you've seen in all of the stock market performance over the last number of months and years. So if you remember when inflation first started to rear its head, Federal Chairman Jerome Powell said he felt that inflation was transitory, meaning he didn't feel like it was something that was going to last. Over time, it proved to be a lot more persistent and continued to grow. And then all of a sudden, we're looking at 8%, 9%. You remember gas prices. You see it now when you go shopping. Prices have raised, wages have gone up. Everything that we spend a fair amount of our money on is raising in price. And so to keep that inflation tamped down, the Fed's only solution is to raise interest rates. And so that's what they've been doing. And you can kind of see the spike in those in 2022 on the right side of this chart. So now what's happening, though, with this episodic volatility is everybody's trying to guess how far they're going to go. How high are they going to raise? When are they going to stop? When is what they're doing going to start working, I think, is the big question. And when you see a bunch of jobs added, or if you see inflation continue to go higher, obviously the conclusion is what they're doing is not working. So one of the big things that in my personal opinion on this, is that the economists and maybe the market writ large isn't really giving this a chance to work, enough time to work. So as they're raising these interest rates, it takes time for that to filter into how we behave as consumers and how companies handle their hiring and firing and right sizing and all of those kind of things. So it's happened so dramatically. I feel like there needs to be some absorption time, but unfortunately we work in a real-time world, live in a real-time world, and the Fed is determined to bring that rate down. And so the far little right purple thing, 2.5%, is where they want to get that inflation down to, so that they can, basically begin lowering rates back down to that point. So the expectation is that they'll keep rising. And so when will we be okay? I think we're going to be okay when the Fed begins to indicate they're taking their foot off the gas. So when they begin to say, we think inflation is beginning to become moderated and starting to come down, we're beginning to see the labor market in the position that we would like to see it. And we want to then inspire capital to get working and going again versus what they've been doing now, which is trying to slow growth. This is the big fear, that by accelerating like they have, they're going to throw us into some sort of deep recession. So that fear is what I will call a known. We know they think that. They haven't hidden that. They're determined to bring inflation down. And so what you're seeing in the market prices today reflects that. The expectation is that we will be in a recession at this point next year, according to consensus. And so that's why stocks have sold off to this level. If that doesn't happen, if the recession is mild, or if somehow we can skirt one, or if all of a sudden inflation dramatically changes and the Fed takes their foot off the brake earlier than expected, we could see a big surprise to the other side. And so when things will get better is when this uncertainty becomes a little bit more clear. And that could take a little bit of time. I won't put a stamp on that, but there's a lot of talk, in the middle part of next year when they've had a few meetings, we're going to get a clear viewpoint of what they're thinking into the second half of next year. The market isn't going to wait for this. If there's any indication that things are going to change, it can move quickly. And I think that that quick move to the upside is just as much of a risk as a quick move to the downside. So that's why I really, really encourage folks to stay invested, stay allocated. These things could change very, very quickly. All right. So what should we be thinking about then? What should we be doing in 2023? And so it's definitely created a new landscape. And I think with rates being where they are, the expectation that they might go up a little bit more from here, but from there they're likely to stabilize. And that's going to make bonds a more attractive place to be. It's because we'll know what those rates are. We can get higher rates on our cash and our money. We can buy bonds perhaps at a discount. If rates then, for whatever reason, began to come down because we went into a recession or the Fed said, we went way too fast. Now we've got to bring this back. Again, an accelerant for the bond market. The other things are these boring places or these obscure investments like emerging markets and small company stocks and mid-sized company stocks like your Harley Davidsons and all these that we haven't been talking about for years, because for 10 years, it's been all large company growth, Apple, Microsoft, Google, Tesla, Meta. So they are going through a recession. Those companies have seen 30% plus drops, many of them 60% plus drops. And don't even get me started on crypto. We've seen just a nightmare market take place in there. And so these companies that were highly reliant on debt or highly reliant on the debt markets to keep that free money flowing have really kind of, seen dire straits. And so that won't go on forever. They'll come back around. But a lot of these more defensive industries, areas that we can continue to further diversify, or those that have sold off but maybe didn't deserve it. Maybe you've got some good family-run companies that are public that have very limited debt and a long runway of consumers that they can sell to or have a big consumer base that they can work with. Those deserve attention. And every time there's a bad market like this, it is going to create some opportunity. And so that's what we're looking at is what should we be doing and thinking about there? How can we rebalance into some of these opportunities? I still love value. And what that means is that buy low, sell high. So if you're buying at the right price over time, you're generally going to be rewarded. Warren Buffett has become a billionaire under that mantra. And I still think it lasts today. It's just changed. It's changed because of the way companies operate with technology. And so there are opportunities out there. The healthcare space has never been changing more rapidly than it is today. Biotech, all of this. So have hope that there is going to be investment spots that we're going to want to take a look at and work on, I think, for sure, in the next few months and years. As far as planning goes, we still have lots of things that we could talk about there. But the big change that's going to come in place now is the Secure Act 2.0. So this is a complicated piece of legislation, to say the least. And so I don't want to, there's no way I could get through all of the details of this because there's so much in there. But you should see on my screen, I'm sharing a file that is about the Secure Act. I put it in a one-pager, so you can download that. If you don't want to mess with it, I'm going to email this out to everyone afterwards so that we've got, you can see some of the details of this. But I just wanted to touch on a few things that I think are going to impact most of you. And so I'm going to start with the changes in required minimum distributions. And so if you'll remember, for over 30 years, once you turned 70 and a half, you had to start taking money out of your retirement plans, whether they're IRAs, 401ks, whatever the case may be. The Secure Act that happened a few months ago changed that to 72. And so that was the law of the land. Well, this new act is now changing it to different ages based on your birth year. And so if you were born before 1951, there is no change. Your required minimum distribution will continue on as it has. If you were born between 51 to 59, the age is pushing back to age 73. So that will give you one more additional year there. Anybody on here that's born after 1960, the RMD age is pushed back to 75. So what does this mean? It means that when you're forced to take money out, they're deferring that until a later period of time. If you need that money and are living on it in your 60s and 70s, this doesn't really have a huge impact on you. But if you've got a large qualified plan, large IRA plan, and you don't want to take money out of it, this is going to allow you to defer that further. I think it also brings into play where we're going to want to do even more with Roth, because they basically, and this isn't my word, but Rothification has become a deal. They are really trying to push Roth in the retirement savings programs in America. So you're seeing it across all these company retirement plans, the Roth conversion rules, all that. In both Secure Act 2.0 and before now is allowing more and more flexibility to get your money built in a component that can grow tax-free. And so I plan to talk about this a lot this year with all of you, because I think making the most of that opportunity is one of our best planning opportunities going forward. Regardless of age, regardless of your situation, there might be a place in your plan for some Roth work. And so this only accelerates that, in my opinion, and it gives us more time to think about it as well if you're getting those dates pushed out. So many of you also do qualified charitable distributions, or what we call QCDs, out of your IRAs or 401ks. There is no change to those and no impact to the age that you can do those. So if you want to start doing them at 70 and a half, you can certainly start, you can do that. So you can begin taking money out of your IRA if you wanted to and donate to charity to avoid that income tax mechanism. So something to be thinking about there. There's rules now around 401ks and IRAs that allow for what are called catch-up contributions. So for those of us like myself that are over 50, they've allowed us to put in extra money into the 401k plans. Usually about $1,000 has been kind of the mantra. In the 401k, it's higher, but in the IRAs, it's been around $1,000. So they're increasing those. And that is going to be effective in 2024 in the IRAs. And then in 2025, the 401k limits looks like it's going to go to around $10,000 for a catch up. So you'll be seeing lots of communication about this, as to how it's going to, when you can do it, but it's going to happen kind of on an accelerating schedule based on your age, turning 60, 61, 62, et cetera. And these higher limits are going to pertain to folks over 60, where in the past it's been 50 and 55, things like that. So again, another big change that's going to be taking place over the next few years. We, as parents, it's when we're saving money for college, we use these 529 plans. And the way they work is you put the money in and then it grows tax-free if you use it for some sort of post-secondary education. Many a parent has told me, I'm concerned about doing this because I'm not sure if little, Jeff or whoever is going to go to school, if he's actually going to go to college. Now I put all this money in this 529 plan, and if I have too much in it, they don't go to school. What am I going to do with it? Well, they put in a new provision where you can convert these 529 plans into Roth IRAs. The way they're going to work is you can take that money, but it goes to junior. It's going to go to the beneficiary and into their Roth IRA. And there's a ton of rules around this. It's got to be in there for 15 years, and it's got to be a direct transfer and things like that. So for many of you, perhaps, that have excess 529 plan money for whatever reason, with the price of college going up like it has many of us, that's not an issue. But for some, it may be. Anyway, this gives you a little bit of an out where some of that money can go into Roth IRA. So kind of a cool provision that has been added in there. They've also added what's called an emergency savings account, effective in a few years here inside of 401k plans. And that is going to allow people to have a little bit of a savings account inside of their 401k. I see this frequently in practice, that folks don't have any savings outside of their 401k plans. And when they do that, it just creates a lot of they have to pull money out before they're ready. It just creates a lot of, as you can imagine, taxes and just unfortunate stuff. And so that's a nice rule to see that emergency savings is going to be available to everyone. And so the Secure Act, this is just a 20-page summary that I've got, and there's been lots of data and stuff out about it. So as more develops, I'll make sure to share that with you and make sure that we keep everybody informed. I'm also going to share this little fact sheet that should be up on your screen. And that has got a lot of the key financial data for 2023, like IRS limits, tax brackets, Medicare limits, Social Security adjustments, all of that kind of fun stuff. And so once again, I'll be emailing this after as well, but wanted to make it available to you if you did have an interest. So, all right. We'd love to see if there's any questions. Again, there's a Q&A and a chat box. You can put either in there. So we're bumping up on a half an hour. So we've had a good discussion. I hope this has certainly been helpful. It was a tough year. There's just no question about it. And so I did want to add some levity just to make it a little bit more interesting, but also just to believe that everywhere that out there right now, there is just so much pessimism. And I saw this after the 2008 market. I saw it with technology in 2001 and 2, that basically the sky is falling and it's never going to get better. And it's not only that I'm seeing it in private clients and folks that I talk to, we're seeing it in a lot of the, you know, institutional publications and stuff too, which again, kind of unusual. And so Marianne at Sanctuary likes to say the consensus is always, is always the way to end up probably losing money, because it never seems to work out the way. And so in my video, I talked about, hey man, at the beginning of the year, we thought last year when I was looking through Wall Street, I always keep last year's stuff just as a point of note when we look at this year. And so I was looking at last year, everybody thought the market was going to do decent. It's going to be up maybe a little bit, you know, kind of see, but no big downdrafts. Well, everybody was wrong. And so at the beginning of this year, the fact that everybody thinks it's going to keep going down in perpetuity with earnings growth accelerating and recessions coming and all of that, it also just makes me question and wonder if that should be questioned and wondered about. And so I really think sticking the course, you hear me say it a lot because it works, but we'll keep our eyes on this and see what happens. And there very well could be some rough times ahead, no question, but we've already been through a lot of that. And I do think there's some reasons for optimism too. All right, any questions popping in here? All right, well, if not, I will let everybody sign off. We'll be releasing the Insights report and sending everybody most likely through an email tomorrow. And we'll have all the attachments that we included here today as well. So if you have any private questions that you want to shoot over to me in email, please do that. I always welcome those. And sure want to wish you all a happy new year. I hope you had a great holiday season. We were blessed to have 3 of our 4 children back home. And so it was great to see everybody. I think we counted over 21 on Christmas Eve over at the Moline Casa. So we had lots of food. As you know, Lisa's an exceptional cook. So we ate like kings, that's for sure. So, all right, have a great new year. I look forward to seeing and talking to everyone. And I thank you so much for attending today. Be well.